Welcome back to another High School Money Matters video. Today we're going to be talking about the engine of the capitalist economy. We're talking about credit.
So, what is credit? Well, credit is really the idea that you can borrow money now and pay it back at a later date with interest. Now, the idea of credit has been around for a long time, but it's only been since the Industrial Revolution that it was really catapulted into the forefront of the capitalist economy. But this video is not about the macroeconomic effects of credit on the capitalist economy. We're really talking about personal credit. If you want to borrow money, how do you go about doing that? What do you need and what do you need to know? Now, in the past, borrowing money for something other than the purchase of a home was sometimes seen as poor money management. But ideals and cultural norms change, and now in Canada, the borrowing of money for everyday purchases is not only acceptable, but nearly universal. Nowadays, nearly every Canadian has a credit card or two in their wallet and uses them often to make purchases. In addition to credit cards and mortgages, many Canadians also finance the purchase of a new vehicle and even the purchase of furniture and other consumer goods. Now, these are the main types of consumer credit that Canadians use most often. We have mortgages, credit cards, lines of credit, and personal loans. For a detailed explanation of those different types of credit, you can head to the Middle School Money Matters video on personal credit. So how do we get credit and how do we apply for credit? That's what this video is all about. Credit is usually given by a financial institution such as a bank or a credit union, and you have to go in and apply, and they will decide based on a few criteria whether they're going to extend some credit to you. Well, let's go over those criteria. Most banks look at three things when deciding whether to extend credit to a client: your ability to repay the loan, which is your income, your past history of loan repayment, this is your credit history, and finally, to a lesser extent, your net worth. If you have a high net worth, meaning that you have a lot of assets already and not a lot of debt, then a lending institution may be a little more willing to be flexible on the first two criteria. Let's go over the first two in detail. The first, and by far the most important, is your ability to repay the loan. Now, this is based on your income. If you walk into a bank and want to apply for a mortgage or a car loan or a line of credit, the bank will ask you where you work and how much you earn. If you have no income and you're applying for credit, most often the answer will be no. There are exceptions to this though, and one of the more common ones is the student credit card. Credit card companies will head out to college and university campuses and offer low-limit credit cards to students with no income. The idea is that they figure if you're going to university, you must have some income in the form of savings or parents or student loans. And so in order to hook you on credit, they'll give you a low-limit credit card with little to no income verification. And your income level is directly tied to how much credit the bank will offer you. If you go in and apply for a $500,000 mortgage that has mortgage payments of $2,500 a month, and you show them that you have income of $2,000 a month, you will be declined because the mortgage payment is higher than your income, much, much higher. There are two main percentages or ratios that the banks use. They're called the gross debt service, or GDS, and the total debt service, or TDS. Gross debt service and total debt service refer to the percentage of your income that the bank will allow you to use in order to make your loan payments. Gross debt service refers to the percentage of your income going toward housing expenses, your mortgage or rent, and any utilities that you need to pay. This number usually should not exceed 32% of your total income. The total debt service is the ratio of your income that goes toward paying not only your housing expenses, but any other credit you might have. If you have a credit card balance or a loan payment or a line of credit payment, all of those add up to the total debt service. Now, this is usually around 40% of your gross income, although it can go as high as 44%. Interestingly enough, both of these numbers are based on your gross income before any deductions like taxes or CPP or EI have come off your paycheck. Let's do an example to show you what I mean. Let's say you earn $20 an hour and you work 40 hours a week. That's $800 a week gross income times approximately 4 weeks per month. That's $3,200 in gross income per month. Using this amount of income, $3,200, we can multiply that by 0.32 or 32% in order to get the gross debt service number. This equals $1,024. On a credit application at a bank, they would not want to see your housing expenses higher than $1,024. So if you were to apply for a mortgage with this type of income, the bank might give you a mortgage with a payment of around $850 a month, leaving approximately $175 a month for your other housing expenses like property taxes, insurance, and utilities. However, in this day and age, $850 a month gets you about a $175,000 mortgage, which is not a lot in this market. The second aspect of any credit application is what's called a credit check. We have two credit bureau organizations in Canada. They are called TransUnion and Equifax. These organizations monitor all the personal credit in the country that is issued by all the major banks and credit unions. And with a client's consent, any financial institution can pull up a credit history on any Canadian client to see how they have done with their repayment in the past. Your credit history yields something called your credit score. As you apply for credit and get credit and make payments on this credit, it will build a credit score for you. If you start to not make the payments for one reason or another, it will start to negatively affect your credit score, and this will also hamper your ability to get more credit in the future. So in review, when you go to a bank and apply for credit, the main two things they're going to ask you is, what's your income? And let's check your credit history. Let's do one more example with our friend here who earns $3,200 a month on a new credit application. This person wants to buy a car, so he heads down to his local bank to apply for a car loan. He walks in, and one of the first things they ask him when they sit down for the credit application is how much he earns. He provides pay slips showing that he earns $3,200 a month and says that he pays $900 a month in rent at a shared apartment, and utilities are included. The banker asks for consent to pull a credit check. Consent is given. The credit check is pulled, which shows that our client has a $5,000 limit credit card, but no balance owing, and has always been making his payments on time. This is good news. So, he wants to apply for a $20,000 loan to purchase a new vehicle. Assuming an interest rate of 5% and a total loan amortization of 5 years, meaning it will be paid back over 5 years, the loan payments for $20,000 will be approximately $377 per month. This bank uses a total debt service ratio of 42%. In order to not exceed a TDS, or total debt service ratio, of 42%, this person's housing expenses of $900 a month plus the loan payment of $377 a month must not exceed 42% of $3,200, their total income. 42% of $3,200 is $1,344. The housing expenses of $900 plus the loan payment of $377 only equals $1,277, which is less than the $1,344. So this loan would probably be approved because the client has good credit history and they're within the total debt service limits. If you'd like to learn more about how loans work, play around with some online loan calculators, inputting different amounts to be borrowed, different interest rates, and different amortization periods. It's really interesting. Hope you enjoyed this video and hope it was informative. On to the next one.